Welcome back to Morning Trade Live. We got a little time here until the opening bell. Let's take a look at how what's happening here at home changes the investment trade-off with the rest of the world. Jeff Kleintop joins us, Chief Global Strategist at Charles Schwab. It's been a heck of a 5 days, Jeff, from inflation and the big reaction there to, of course, the way the political expectations have shifted after attempted assassination. I mean, where in your work do you kind of begin here to evaluate how things have shifted?
Yeah, we've had a lot of surprises, and that's sort of the name of the game. I think we saw a number of those in the second quarter. We're likely to see a number of those in the second half of the year. I think one of the things that jumps out at me today was the retail sales report. I know it's sort of out of sync with what you just set up, but I think it's interesting because it was solid. But the U.S. data has been worse than the rest of the world in terms of how the data has been faring versus expectations. Mm-hmm. One of the surprises I've noted lately is data is been coming in worse than expected. That wasn't true a couple of months ago. The quarter began with surprisingly strong global economic data that exceeded expectations, but now it's been coming in a lot weaker. And I think the market was fine with that because it meant it was a greater likelihood that central banks would cut rates in the second half of this year. Now that the market is pricing in 2 rate cuts from the Fed, 2 additional rate cuts from the ECB, maybe further negative economic data surprises may be less tolerated by stock market investors. So, it's one of the themes out there that I think is interesting here as we look to the third quarter. I think markets are expecting solid data. They make it something else.
I like the global look at this index, which certainly getting dragged, not a great thing, but if the trade-off is for cuts, then that works too. Does the global also include U.S. or is that ex-U.S., Jeff?
That does include the U.S., and I'll say that it's the U.S. and the Eurozone that's really pulling that number down. Japan's actually been moving higher, Canada's been moving higher, and the U.K. has been moving higher. So if you think of the G5, if you will, it's really the U.S. and those members of Europe that are pulling that number to the downside.
Okay. And so when we look at this kind of trade-off then, if the U.S. does start to respond by following the central bank path the rest of the world has got the leg up on, does that kind of change some of the appeal at all? Does it make the U.S. more appealing than it had when we were missing data, but the Fed couldn't cut? Because this whole Russell thing is like, it's a very domestic thing.
It certainly makes the small cap picture look a little bit brighter, right? We've seen better move here in the Russell 2000 lately. We saw small caps outperform in Europe in the second quarter as they started to cut rates. And now maybe with rate cuts in the U.S., you can see some momentum there. So that makes maybe U.S. smaller caps more competitive with the outperformance we had seen in Europe in Q2.
Okay. All right. So economic surprise generally not going our way. To your point, the retail sales, a pretty distinct exception to that this morning. Now, when you look at how this kind of fits into our overall themes, does it change any of the kind of expectations you have or the preference for international?
I am focused on earnings right now as we go through the earnings season. I know there's so much else going on, but I'm looking for signs that there is a brighter picture in Europe than the U.S. If there isn't, then I think the U.S. Will probably outperform here in Q3. But what I'm seeing is, better momentum to some of the earnings numbers, in part on easy comparisons to last year for sure when Europe was in a recession. But it looks like we're now in a quarter where earnings are going to grow faster in Europe than in the U.S. If that continues to pan out as we move through the Q2 earnings season and we get guidance on Q3, then I think that that outperformance for international remains intact. If it doesn't, and you see better momentum here to U.S. growth, there may be a broadening of U.S. earnings growth outside of just those AI names. I think that could sustain some of the near-term U.S. outperformance.
Pretty much neck and neck right now here over the last couple months, at least going back to April here.
Yeah, this chart's an interesting one. In the second quarter, you saw emerging market stocks outperform the S&P 500. That was a surprise, given all the headwinds facing China. Not even getting into the election issues. I don't think that's going to continue in Q3. You've got far too many headwinds, I think, with China. We're in the middle of their 5-year planning meeting for their economy. Those takeaways will be released on Thursday, and we get a Politburo meeting at the end of the month. So there could be some new stimulus measures enacted or at least announced later this month that could maybe give you another bounce in Chinese stocks. But the economic growth in the second quarter came in below expectations. They're still struggling with that property problem and very, very weak consumer confidence. I just don't see Chinese stocks topping the S&P 500 again in Q3.
Okay. All right. Nice. Knocked out a few major regions there. Some other themes, Jeff. Do we have new insight onto whether ECB, Bank of England, Bank of Canada, are these central banks that cut going to continue? Will it be stair step? Will it be straight down? What is the read right now on what their rate cycle looks like?
Yeah, I guess a stair step is a good way to put it. Maybe skipping a meeting in between and cutting every other one. We got the Canada inflation numbers this morning, pretty good, on track for further rate cuts there. They already cut once; they'll likely cut again. And yeah, we're seeing the data in the UK come in, suggesting the Bank of England is close to cutting as well. I think September is very likely for the ECB to put in their next rate cut. So yeah, I think we're on that kind of stair step approach to cut, skip, well into the middle of next year. So obviously things can unfold many different ways given the elections and many other factors, but I think that's the path that we're on, and that's one of the reasons why we've seen currencies kind of move the way they have this year. But now, given that the Fed is kind of looking at maybe that type of a move as well, maybe we're seeing less of a gap between the movements in the dollar and the euro.
Okay. Yeah, dollar really has gotten hit here. Our yields have dropped, of course. Just trying to get insight basically onto the notion of a cutting cycle, because we did move pretty quickly to that narrative here since that last inflation print. Maybe some of the Powell language to some extent saying that, we're making improvement, but this idea that we are going to do a very historically normal kind of beginning of the first cut means there's a bunch more behind. I mean, is it still a little bit kind of murky if that's the case for these other central banks? Because you're talking like skipping meetings and stuff.
Yeah, I am. And rates aren't obviously going to go back to where they were. And there is still an open question as to where they go. So we've got, probably, a few quarters ahead of us where we go and skip and go and skip. But then where do we stop? And then is there a risk of inflation reviving and this having to go in the other direction? Knowing that there are still a number of issues with global supply chains. There's still the potential of tariffs, not just in the U.S., but around the world, raising domestic prices. A number of concerns out there that could maybe put the Fed back in the game, or other central banks back in the game, looking out a year or two from now, maybe having to, if not keep rates stable, maybe even hike them again. We're in a more volatile period for inflation going forward. So I'd expect the markets to think further out, maybe 2 years out, as to where rates are going to be. I know we didn't see that in the dot plot, but I think it's something to consider, that rates might just go down and stay down. They might be forced to move back up again, a more volatile period for Fed action in the years ahead.
All right. Hey, Jeff, one other question as it pertains to politics. Is there any things similar happening in any of these other elections around the world that give us an idea maybe how markets would respond to a Trump-like figure? Is that too murky of a description? Like, is there any precedent? I think like the first time around it was this kind of very clear populist wave, but I'm not sure if that's like the right way to describe it. I'm not the politics guy. Does any of what's happened around the world give us any indication how to think from a market's perspective what might happen if the former president comes back?
I think it's hard to draw any parallels with what's happened this year. Okay. Election trades are just hard. I remember when gold was the Trump trade ahead of the 2016 election because of the chaos that might ensue if Trump won, but that turned very quickly and the markets welcomed the Trump presidency and the outlook for rate cuts. Small caps have more domestic sales, but the products they sell are often imported and therefore could be subject to higher tariffs. So that enthusiasm could turn, and it's far too easy to be sure what the policies might be once they're implemented. So I think the idea of more confidence in rate cuts, maybe more fueling borrowing sensitive small caps here than the election. But certainly election trades are fraught with risk, not only because it's hard to predict what's going to happen with the election, but then how the markets are going to interpret that and then what the actual policies may be.
All right. Good stuff. Jeff Kleintop always giving us some great perspective.
Thanks,
Appreciate that, sir. Jeff's Chief Global Investment Strategist to Charles Schwab.